So the way the Federal Reserve got us out of the financial crisis, the way the Federal Reserve got us out of the COVID crisis was by creating inflation. The Fed's solution to every problem is inflation. Well, now the problem is inflation. So that's the box, because how do you solve the problem of inflation if inflation is your only solution to every problem?
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
You know, my warnings of the bubble that the Fed was inflating in the housing market really started in about 2002, 2003 timeframe. So by 2005, the bubble was really at its peak, but I was sounding the alarm years before then. I could see the monetary policy mistakes that the Fed was making and the impact those mistakes were having on the housing market, on the mortgage market. And I knew that it was just a matter of time before the whole thing blew up. And of course, I knew the longer it would take to blow up, the bigger the crash would be. Those problems are much worse now. Yes, we don't have the specific subprime mortgage issue, but the subprime market was really just kind of the tip of the credit bubble. There was a lot going on, you know, besides subprime that was problematic. That was just the most obvious, and it was the first link in the chain to crack. But if it wasn't, you know, subprime, it would have been something else. But the problem is the debt in the economy, which is much greater now than it was then, and the underlying structure of the U.S. economy, which is even more screwed up now than it was then. The trade deficits are larger today than they were during that time frame, which means we have an even more dysfunctional economy because we rely on imports. We can't produce the things that we consume. The economy is incapable of doing that. And so we rely on the rest of the world to supply us with the goods that we can't produce, but we have no way of paying for those goods. So the external liabilities continue to grow. The debt that America owes the world continues to grow. And at some point, the lenders are not going to want to continue because they are going to realize that they're not going to get paid, you know, not in real money. And finally, inflation has reared its head in a very visible way in the last couple of years. And this is evidence that it's about to fall apart, because inflation is really what breaks this whole deal. Because once the dollar starts losing value, then people want to get rid of their dollars. And we need people to hold their dollars if we want to keep importing. But if we can't import, you know, a whole economy that's based on borrowing money to buy imports is going to collapse. It can't be managed at a moderate level. To avoid hyperinflation, a lot of bad stuff's going to have to happen. At least it's going to feel bad. From a macroeconomic perspective, it's going to be good stuff. It's going to be solutions to serious underlying economic problems. But, you know, the politicians and the central bankers really have no stomach for those type of free market solutions that will actually work. Because before you get the gain, you get the pain. And none of the politicians want pain because they're afraid that they won't get reelected. And so they'd rather kick the can down the road so that the pain happens after some future election when somebody else is in office. So that's what's happening. But what you're seeing right now is the Fed having reacted to inflation that it claimed didn't exist or was transitory. And it's now raised rates up to, 4.5%, 4.75%, and it's projecting the rates to get just above 5% over the next few months. A lot of people think that that's it, that that's enough, that the inflation genie is now back in the bottle. We just have to wait a few more months. It's going to go back down to 2%, and then the Fed can start easing up again and lowering rates, and everything is going to be great. But that's not what's going to happen. I think the improvement we've seen in the inflation numbers, that's what's transitory. I think by the end of this year, the inflation numbers are going to be moving decisively higher again. And it's going to be obvious that the Fed is nowhere near its goal of 2% inflation. It's going to need much more substantial hikes than what has happened so far. But I think by then you're going to see some kind of rollover in the labor market, notwithstanding the big job numbers we just saw. And, I've been looking at the nature of these jobs that we've created. And over the last 10 months, we've actually destroyed full-time jobs. You have fewer people who have full-time jobs today than we had 10 months ago, despite all these jobs, including the 500,000 that were just created in January. On balance, these are part-time jobs, and they're going to people who already have jobs. So why are so many people moonlighting? It's because inflation is so bad that it's destroying the value of their paychecks. So they need another one. And so you have record numbers of people working 2 or 3 jobs. You have people who are retired. They're being forced back into the workforce. So I think that by the end of the year, though, we're going to have to start to see a pronounced weakening in the labor market. The economic data is already weak. I think it's going to get weaker. And then the Fed is going to be in a real bind because it's going to be facing higher inflation and a weakening economy and a weakening labor market, but rates are already going to be above 5%, which and they would have had no effect. And so they're going to think, well, what are you going to do, 7%, 8%? But this economy was not even built for 5%. The phony economy that the Fed built needs 0%. That's basically the highest we can afford. We have a $31.5 trillion national debt, and they're raising the debt ceiling, and it's going to go a lot higher. But if rates stay at 5% for a few years, it's going to cost more than $1 trillion just to pay the interest on that national debt, which there's no way the government's going to get that money. It's going to have to borrow that, which means the budget deficits could go to $3 trillion a year. Well, how are they going to fund those? The Fed's going to have to go back to quantitative easing. And that's the risk of hyperinflation, because the Fed really can't fight this inflation with an interest rate that is high enough to do the trick, but that we can actually afford. And more importantly, there's no way to really fight inflation without cooperation from the government. The government needs to cut spending, but they're not doing that. They're increasing spending. In fact, as the economy weakens, they're going to increase spending even more. In fact, what their motivation is, when consumers are struggling with high prices, they want to spend more money. They want to give people stimulus checks so they can afford to pay the higher prices, which is just more inflation. So, inflation is a huge problem. And, the hidden truth is that inflation has been the Federal Reserve's, ace in the hole. I mean, that's how they've gotten us out of every problem, inflation. Quantitative easing is a euphemism for inflation. That's all it is. So the way the Federal Reserve got us out of the financial crisis, the way the Federal Reserve got us out of the COVID crisis was by creating inflation. The Fed's solution to every problem is inflation. Well, now the problem is inflation. So that's the box, because how do you solve the problem of inflation if inflation is your only solution to every problem? Well, I mean, the government gives us these inflation numbers. And the inflation numbers basically are a report card on the economy. The same thing with the GDP numbers. Well, if we allowed our children to grade their own report cards, would we be surprised if they came home with straight A's? No. I mean, obviously, the government has a vested interest in telling the public that the economy is better than it really is. So it wants to tell the public that there's less inflation than there is, that there's more economic growth than there is. And so they create these numbers to, come out with being better than reality. Now, a lot of people say, well, that's a conspiracy. Are they fudging the numbers? They're not fudging the numbers. The way they measure the numbers, that's been designed to fudge them automatically. So nobody has to do anything. All you have to do is use the government formula, and you're going to get these rigged numbers. And, one way I even showed this back in 2013, right? So this is a while ago. I just did a little experiment. I mean, I could do the same experiment again. Maybe I should. It was a very good one. But what I did is I looked at the prices that the government claimed the increases. And then I looked at actual increases. And so one of the things I looked at was newspapers and magazines, because that was real easy. So according to the government, from 2003 to 2013, newspaper and magazine prices were up a total of 30% over those 10 years. So that'd be about 3% a year, right? So I went back and looked at, on the internet, at 2003 images of the most popular newspapers and magazines in the country. Right? U.S. News and World Report, Time, Newsweek, New York Times, Wall Street Journal, Los Angeles Times, all these newspapers and magazines. And I just looked at the prices. And then I looked at the prices that are printed on the covers then in 2013. So I could compare exactly what they were. So I added everything up, and figured out the increase. And the actual rate of increase in newspaper and magazine prices was 130%. So the government said prices are up 30%, but the prices themselves were up 130%. So what happened to that 100? How did a 130% rise become a 30% rise? I have no idea. That's the magic of the CPI. It makes inflation disappear.